Many of us were raised to believe the safest place for our money is locked inside a traditional bank savings account. But while that cash sits perfectly still, it is quietly losing value through a process called inflation. This chart shows the mechanics of that loss. If inflation averages 3% and your bank pays only 0.5%, you lose 2.5% of your purchasing power every single year. Storing cash in a standard account is an active financial risk. To maintain your wealth, you have to move money into assets that outpace inflation, most notably the stock market. This chart shows the power of that transition. The S&P 500 has returned an average of about 10% annually over the last century. At that rate, a single $10,000 investment grows to $174,000 over 30 years without any additional contributions. Long-term security relies on converting stagnant cash into growth-generating assets. Once your investments start growing, you face a second leak: taxes on your capital gains. Canada provides specific registered accounts designed to block this tax drag, starting with the Tax-Free Savings Account, or TFSA. The TFSA is a specialized investment wrapper. Every dollar of growth and all dividends earned inside this account belong to you, completely free of taxes. While the TFSA offers total tax-free growth, the RRSP works by deferring those taxes. It's most effective for higher earners or those who receive an employer match. There's also the First Home Savings Account, combining a tax deduction on contributions with tax-free withdrawals specifically for a down payment. This flowchart shows the standard Canadian order of operations. You prioritize the TFSA for its flexibility and tax-free status, then move to the RRSP or FHSA based on your specific housing or retirement goals. Selecting the right tax-sheltered account is a priority because blocking the tax leak provides an immediate boost to your baseline returns. But what do you actually buy inside these accounts? Popular culture suggests that investing requires picking individual stocks or trading constantly. In reality, most professional fund managers underperform the market over the long term. A more effective strategy for beginners is to use passive index funds and all-in-one ETFs. An all-in-one ETF uses a single ticker symbol for fractional ownership of thousands of global companies. This diversification protects you, but watch for the third invisible leak, the MER fee. Canadian mutual funds often charge 2%, while passive ETFs charge 0.2%. Over 30 years, that 1.8% difference can cost an investor tens of thousands of dollars in lost compounding. You can plug this leak by opening a no-fee brokerage account, purchasing a low-cost ETF, and automating your deposits. The financial industry relies on the perception that investing is complex and expensive. However, the data shows that the simplest, lowest-cost strategy is often the most effective. Many people delay starting because they believe they need a large sum of capital to begin. This graph shows that time is your most important lever. Because early contributions have more time to compound, starting with just $25 a month is more effective than waiting years to start with more. To protect that powerful growth, you must absolutely avoid the sudden urge to panic and sell when the stock market inevitably drops. Exiting the market during a downturn transforms a temporary price decline into a permanent loss. By using tax-free accounts, broad, low-fee ETFs, and a long-term perspective, you plug the leaks draining your wealth and build a self-sustaining financial engine.